Welcome to the Capital News. I'm your host, Alex Karitis. Today is Friday, March 5th, 2021. Thank you so much for joining me. The title of today's podcast is February Jobs Report. Before we get that, quick shout out to my yaya. It's her birthday, 89 years old, beautiful inside and out. We love her dearly. She listens to this podcast every morning with her breakfast, so good morning. And I wish you a very happy birthday. Love you more than you'll ever know. So everybody who's listening, send Yaya a happy birthday wish. She will love it. Thank you so much. So we're going to get to some market performance. Obviously, the jobs report for Friday. And those of you who are just joining, perhaps, we have been reading the jobs report since last March or April, once all of these restrictions and lockdowns came to pass, because we're in historic times. So instead of just going off of the headlines, which we never do here anyway, we always like to look under the hood. That's what we do. So instead of just focusing what Bloomberg or Fox Business or CNBC, just, nitpicking a couple data points here or there, we give you the whole thing. Okay? We give you the whole thing. And that's important because context is important. And now we have a Federal Reserve, members of the Fed, now not just the chair of the Federal Reserve, Jay Powell, but other members of the Federal Reserve have been coming out and saying, well, yeah, the official jobs report figure, the official unemployment rate, that's not accurate. Yes, it's 6.3, 6.2% according to the Bureau of Labor Statistics, but we honestly believe that it's closer to 10%. Okay? This doesn't happen. Fed members calling out a government figure, calling it bogus, basically. Again, that's why I continue to reiterate this almost on a daily basis. Some other data points we want to discuss too: productivity, unit labor costs, trade deficits not good, and then sort of tie in some emerging market discussion when we go over market performance, which we're going to get out of the way right now. Dollar index is at 91.99, so call it 92. Okay, this could be busting up. If that's the case, this is going to put some downward pressure, most likely, on equities, especially here in the U.S. Of course, we continue to see the 10-year rise, and we'll get to that as well. Let's see here. We have just a lot of dollar strength across the board. The euro has weakened to $1.19. The British pound has weakened to $1.38. The Australian dollar has weakened to 76.8 cents to the dollar. The New Zealand dollar has weakened to 71.5 cents. Recall, all of these figures, all of these other currencies, the euro, the pound, the Aussie, the New Zealand Kiwi, they were all up 2 to 3 pennies not too long ago. Now, of course, those of you who don't pay attention or monitor closely the foreign exchange market, those are big moves, especially in major cross-currency pairs. So this can do damage with a strengthening dollar. And again, I have always been talking about this, that the dollar still very much can have a swan song. Net, the dollar is going down. Okay, what we are doing with the printing press, what Congress continues to do, we are a banana republic. So the dollar is going to go down, net, over time, as are all of these other make-believe, phony fiat currencies, because all of their governments and central banks are doing the same thing. So it's a race to the bottom, but in that race to the bottom, there's going to be some volatility. Nothing goes straight up, nothing goes straight down. But with a appreciating dollar, this, again, we talked about this, could end up turning into some sort of dollar doom loop where you have an appreciating U.S. dollar, you have depreciating other currencies, and so it's going to tie in especially to emerging market concern, because due to the pandemic, emerging markets, just like everybody else and their mother, loaded up on debt. Okay? And a lot of their debts are dollar denominated, U.S. dollar denominated. And the reason they do that is because it gives a little bit more credence for potential investors to buy up their debt. Because the U.S. dollar, of course, is the world's reserve currency. It's backed by the U.S. government, Federal Reserve, the Treasury, and of course, really that means the U.S. taxpayer. Okay? So instead of actually going into a third world currency, a banana republic, and saying, we don't want their currency, but if you issue your debt in dollars and you're going to pay us back in dollars, okay, we'll take that gamble. But if you have an appreciating U.S. dollar, you have depreciating emerging market currencies, it's going to be that much more expensive for those emerging markets to pay off their U.S. dollar denominated debts. Okay? So they're going to have to spend more of their resources paying off debt. This is why you do not attempt to solve a debt problem by adding more debt onto the system. Now, one would think this is pretty easy to understand, but apparently our fearless and brilliant leaders around the globe can't seem to grasp this very easy concept. So this is going to play itself out. Market forces are going to play out, and this is not going to end well at all. Another thing that gives me concern, obviously, is protests, potential revolutions, civil wars, serious riots, etc., etc., and it's going to take place in those weaker link countries first, which is what we have been witnessing. And of course, it's here in the United States as well, developed economies in Europe, etc., etc. So we're not immune to this, and it's most definitely going to happen here as well. But it's those weakest links that are going to break down first. So imagine all of these countries. They are saddled with all of this debt. They have a lot of young people who are sick and tired of dealing with these restrictions, these lockdowns, the debt, the lack of opportunity and prosperity, the nepotism and corruption that exists within their respective governments, and so they revolt. Okay, this is easy to connect these dots, but in the process of these protests, riots, revolutions, whatever comes of it, you think there's going to be a lot of people working? There could be a lot of strikes, production's going to shut down, and in a lot of these emerging markets, you have a lot of commodities that are produced in these countries across the board: energy, precious metals, industrial metals, agricultural products. Well, if these people are more focused on the economy and revitalizing it, but they have to overthrow their governments first, well, they're probably not going to be working. So you can imagine the supply disruptions that may very well play out over the coming years. Well, what's that going to do to prices? Well, they're going to continue to spike, almost regardless of what demand is. If you have this type of serious supply disruption, which I imagine is going to take place. Plus, with all of these lunatics printing all the money, which is inflation by definition, it's a 1-2 knockout. Okay, so I am seeing this play out. I hope I'm wrong, but I think the writing is clearly on the wall for something like that to play out. So the dollar strengthening is something that is going to probably be of concern to the Federal Reserve at some point if it isn't already. Same goes for the 10-year yield and the 30-year bond yield continuing to rise. And of course, the Fed will have their FOMC meeting in about a week and a half, so all eyes and ears will be pegged to that, which of course is ridiculous, but that's the market we live in. It's not a free market system. It's a centrally controlled system, which is why we wait for one or two people to say something, and then we go from there. All right? Choppy session today on Wall Street. Started off up, then it went down big, then it rallied big. Okay? We just talked about this. These markets are a joke, fragile markets, a couple podcasts we did this week. Nonetheless, the Dow Jones Industrial Average put on a gain of 1.96%. The S&P 500 put on a gain of 1.97%, and the NASDAQ 100 put on a gain of 1.57% for the day. A choppy session across the pond in Europe. On the share price front, pretty much everything was up for the day on the screen that I'm looking at. Of course, Tesla gave back another 3.8% to trade at $597 per share. So Tesla has been on a wild ride to the downside. Is reality just catching up with the fun, with this poster child of this bubble market? We shall see. Microsoft put on a gain of about 2%. Amazon up 0.8%. Facebook up strong 2.5%. And one of the biggest gainers was ExxonMobil putting on a gain of 3.8% because oil continued to rally today. WTI and Brent both up over $2 per barrel. WTI, $66.26 a barrel. Brent, $69.53, so flirting with a $70 a barrel figure for the international metric of Brent oil. Natural gas, $2.70. Gold and silver hanging on. Gold at $1,700 an ounce. Silver $25.24 an ounce. Copper hanging on, $4.10 a pound. So that's the other thing that's going to keep hitting us, right? We continue to see a deterioration in this economy. I know that's not the story, but when you have 745,000 Americans file for initial jobless claims last week, yeah, that ain't good, folks. That ain't good, especially when it's still like 80, 90,000 higher than where we were during the depths of the great financial crisis, okay? And we're basically hitting the one-year anniversary of this. That 650, 660,000 figure during the GFC was for a couple weeks. We've been north of that for a year. All right? This is destructive. This is devastating. And now we have oil prices back to where they were pre-pandemic. It doesn't take a genius to connect the dots to solve this equation. It is not good. Okay? And that's not good for a lot of emerging markets either. Because a lot of those countries are dependent on importing a lot of their energy. Prices go up, well, that's where a lot of their resources are going to end up going. You can see how this is going to play out. Rounded out, Uncle Sam's 10-year junk note is yielding 1.58%. 1.58%. And the 30-year long bond is at 2.3%. So those are causes for concern, obviously, for the market and for central bankers. So we'll continue to monitor those discussions as we move ahead. With respect to some other numbers before we get to the jobs report, we have productivity decreasing 4.2% in the fourth quarter of 2020, and unit labor costs increased by 6%. These are annual rates. I'll repeat. Productivity decreased 4.2% in the fourth quarter of 2020, while unit labor costs increased by 6 percentage points. Well, this makes sense. Nobody's working. So how is productivity going to go up? Okay? This is the exact opposite of what you want to see. You want to see productivity increasing, which would drive costs lower. That's how it's supposed to work. But when you have the government in there picking winners and losers, shutting everybody down, this is what happens. Okay? What else happens when the government gets involved? U.S. trade deficit widened in January as Americans bought more imported goods. Wall Street Journal. The U.S. trade deficit widened in January as American consumers stepped up purchases of computers, cell phones, flat-screen TVs, and other imported products. You know, the necessities. The deficit in trade of goods and services expanded by 1.9% to a seasonally adjusted $68.2 billion in the month of January, according to the Commerce Department, compared with a $66.97 billion gap in December. Imports increased 1.2% to $260.2 billion from December, while exports grew 1% to $191.9 billion. Imports have returned to pre-pandemic levels after dropping sharply starting in March. And here, you know, they're contributing this splurge on consumer products to the additional $600 a week payments that many Americans received last year. Well, who would have thunk that? All the necessities. Computers, cell phones, flat-screen TVs. Might as well live it up while you're in lockdown, right? Now, when you look at net exports of goods and services in aggregate here for the fourth quarter of 2020, that's at a negative $804 billion. Negative $804 billion. The only time it has been worse than that was prior to the great financial crisis, which was at $805 billion. So we're basically there. Okay, so this Make America Great Again, all these fantastic trade deals. Nope. I mean, even if I was to give the Trump administration credit, which on some things I obviously do, you have the first quarter of 2020 where net exports came in at a negative $494 billion. Now, that was a sharp increase, but that really just took us to where we were during pretty much almost the entirety of the Obama-Biden administration. Okay? And then, of course, with the pandemic and the recession and everything, it just, started to collapse. But that's no surprise, given the policies that we adopt and implement. This does not have to be the case. Other countries aren't running these types of deficits, and they had lockdowns and restrictions, or they had to deal with COVID-19. It's a question of your policies. Didn't have to be like this, but it was. So now we have our national debt hitting $28 trillion. Again, pop the champagne. Congratulations, everybody. Make sure you give it to your young children and grandchildren, and save a glass for the great-grandchildren who yet to be, because they're the ones buying the bottle. Okay? That's what that means. Spending $8 trillion, $4.5 trillion of which we do not have. That's more than the tax receipts that we bring in. Okay, this is ridiculous. Why have taxes? I would love for these questions to be asked of Jay Powell. If we can continue to run these types of deficits, then why have taxes at all? Just print the money and call it a day. So we got to deal with the twin deficit, the fiscal deficit, and this collapsing trade deficit here. This is terrible, okay? So all of this money printing is going to finance the productivity of other countries. How is that benefiting us? That's the situation we are in. So here is the jobs report. Total non-farm payroll employment rose by 379,000 in February, and the unemployment rate was little changed at 6.2%. In February, most of the job gains occurred in leisure and hospitality, with smaller gains in temporary help services, healthcare and social assistance, retail trade, and manufacturing. Employment declined in state and local government, education, construction, and mining. So again, the number 379,000, that beat expectations. But as I just stated earlier, and basically the bulk of yesterday's podcast, 745,000 Americans filed initial jobless claims. So fantastic. Here is the household survey data. Both the unemployment rate at 6.2% and the number of unemployed persons at 10 million changed little in February. Although both measures are much lower than their April 2020 highs, they remain well above their pre-pandemic levels in February of 2020 of 3.5% and 5.7 million, respectively. Among the major worker groups, the unemployment rate for Asians declined to 5.1% in February. The rates for adult men, 6%, adult women, 5.9%, teenagers, 13.9%, whites, 5.6%, blacks, 9.9%, and Hispanics, 8.5%, showed little or no change. Among the unemployed, the number of persons on temporary layoff fell by 517,000 in February to 2.2 million. This measure is 1.5 million higher than the level a year earlier, but is down considerably from the recent high of 18 million in April of last year. The number of permanent job losers at 3.5 million was essentially unchanged in February, but is 2.2 million higher than a year earlier. That's one of the numbers we like to pay attention to. So that has been stubbornly high at 3.5 million. It's good that it hasn't increased significantly, but it's not good, of course, that it has not decreased significantly either. And 3.5 million, I think, takes us back to where we were 8-9 years ago, okay, coming out of the GFC. The number of long-term unemployed, those jobless for 27 weeks or more, at 4.1 million changed little over the month, but is up by 3 million over the year. In February, these long-term unemployed accounted for 41.5% of the total unemployed. The number of persons jobless less than 5 weeks, at 2.2 million, also changed little over the month. So we're continuing to see significant duration of unemployment. This is because we are in the midst of a structural unemployment and underemployment situation. This is not going to go away anytime soon, even if and when the economy starts to quote-unquote open up again. So much of the devastation has already been done, and a lot of it still has to make its way through the system. The labor force participation rate remained at 61.4% in February. This measure is 1.9 percentage points lower than the value a year earlier. The employment population ratio at 57.6% changed little over the month, but is down by 3.5 percentage points over the year. So these numbers also remain stubbornly high or bad, which depending on the ratio here. Again, not good. And this is looking deeper into the report. We'll have a follow-up conversation on this probably next week, as we did last month as well. The number of persons employed part-time for economic reasons at 6.1 million changed little in February, but is up by 1.7 million over the year. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. In February, the number of persons not in the labor force who currently want a job was at 6.9 million, little changed over the month, but up by 1.9 million over the year. These individuals were not counted as unemployed because they were not actively looking for work during the last 4 weeks or were unavailable to take a job. So there you have it, 6.9 million people not working, but not counted as not working. Phenomenal. Among those not in the labor force who currently want a job, the number of persons marginally attached to the labor force at 1.9 million was essentially unchanged in February, but is up by 453,000 over the year. These individuals wanted and were available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the 4 weeks preceding the survey. The number of discouraged workers, a subset of the marginally attached, who believed that no jobs were available for them, was 522,000 in February, also little changed from the previous month, but up by 121,000 over the year. A little bit of household survey supplemental data. In February, 22.7% of employed persons teleworked because of the coronavirus pandemic, down from 23.2% in January. These data refer to employed persons who teleworked or worked at home for pay at some point in the last 4 weeks specifically because of the pandemic. And of course, this is something that is part of the broader conversation as to how many Americans are going to continue to work from home once the economy opens up. No, I mean, it could be some sort of hybrid situation where instead of going into the office 5 days a week, maybe you go in 2 or 3 times a week. That's still going to put downward pressure on commercial real estate. And of course, we're still in the midst of that mess, which hasn't even come to fruition yet. Okay, there is so much waiting in the wings. When you print trillions of dollars and spend trillions of dollars, you're going to have a good time, or you're going to be able to mask over some things. Reality is going to sink in as it always does. In February, 13.3 million persons reported that they had been unable to work because their employer closed or lost business due to the pandemic. That is, they did not work at all or worked fewer hours at some point in the last 4 weeks due to the pandemic. This measure is down from 14.8 million in January. Among those who reported in February that they were unable to work because of pandemic-related closures or lost business, 10.5% received at least some pay from their employer for the hours not worked, down from 12.7% in the month of January. Among those not in the labor force in February, 4.2 million persons were prevented from looking for work due to the pandemic. This measure is down from 4.7 million in January. To be counted as unemployed, by definition, individuals must be either actively looking for work or on temporary layoff. So I guess that's good, obviously, that people are starting to come in a little bit. Okay, that number's down, that they weren't prevented from looking for work, at least according to them. So that was 500,000 to the positive side, but still stubbornly high. And we'll get to some of this at the end of this report, just some conversation as we get a further breakdown of where the jobs were added. So now we are on to the establishment survey data. Total non-farm payroll employment increased by 379,000 in February, but is down by 9.5 million, or 6.2% from its pre-pandemic level in February of last year. In February of this year, most of the job gains occurred in leisure and hospitality, with smaller gains in temporary help services, health care and social assistance, retail, trade, and manufacturing. Employment declined in state and local government education, construction, and mining. In February, employment in leisure and hospitality increased by 355,000 as pandemic-related restrictions eased in some parts of the country. About 4/5 of the increase was in food services and drinking places, so your restaurants, your bars. Employment, so that was an increase of 286,000. Employment also rose in accommodation, up 36,000, and in amusements, gambling, and recreation, gaining 33,000. Employment in leisure and hospitality is down over the year by 3.5 million, or 20.4%. Within professional and business services, temporary help services added 53,000 jobs in February, but is down by 175,000 from a year ago. Employment in healthcare and social assistance increased by 46,000 in February. Healthcare employment was little changed over the month, gaining 20,000, following a large decline in the prior month, losing 85,000. In February, job gains in ambulatory healthcare services gained 29,000, were partially offset by losses in nursing care facilities, losing 12,000. Employment in special or social assistance rose by 26,000, mostly in individual and family services, gaining 18,000. Employment in healthcare and social assistance is still down by 909,000 over the year. Retail trade added 41,000 jobs in February. Job growth was widespread in the industry, with the largest gains occurring in general merchandise stores gaining 14,000, health and personal care stores gaining 12,000, and food and beverage stores gaining 10,000. These gains were partially offset by a loss in clothing and clothing accessory stores losing 20,000. Following steep losses in March and April of 2020, negative or minus 2.4 million jobs over the 2 months combined, retail trade has added 2 million jobs from May through February. So you can just see the size and scope of the devastation that we witnessed last year and unfortunately are still in the midst of. Manufacturing employment increased by 21,000 over the month, led by a gain in transportation equipment up 10,000. Employment in manufacturing is down by 561,000 over the year. In February, employment declined in local government education, down 37,000, in state government education, down 32,000. For both industries, February losses partially offset gains in January. Pandemic-related employment declines in 2020 distorted the normal seasonal buildup and layoff patterns in the education sector, making it more challenging to discern the current employment trends in these industries. Employment in construction fell by 61,000 in February, largely reflecting declines in non-residential specialty trade contractors, down 37,000, and heavy and civil engineering construction, down 21,000. Severe winter weather across much of the country may have held down employment in construction. Employment in the industry is 308,000, below its level a year earlier. Mining has shed 8,000 jobs in February, with losses occurring in support activities for mining, down 6,000, and in oil and gas extraction, down 2,000. Mining has lost 153,000 jobs since an employment peak in January of 2019, though nearly two-thirds of the loss has occurred over the past year. In February, employment changed little in other major industries, including wholesale trade, transportation and warehousing, information, financial activities, and other services, which I believe was the case in last month's jobs report as well. In February, average hourly earnings for all employees on private non-farm payrolls increased by 7 cents to $30.01. Average hourly earnings for private sector production and non-supervisory employees at $25.19 changed little, gaining 4 cents. The large employment fluctuations over the past year, especially in industries with lower paid workers, complicate the analysis of recent trends in average hourly earnings. So give us the median. The average work week for all employees on private non-farm payrolls declined by a third of an hour to 34.6 hours in February. In manufacturing, the work week declined by 0.2 hours to 40.2 hours, and overtime declined by 0.1 hours to 3.1 hours. So that's not good. The average work week for production and non-supervisory employees on private non-farm payrolls declined by 0.4 hours to 34 hours even. The change in total non-farm payroll employment for December was revised down by 79,000 from a negative 227,000 to a minus 306,000, and the change for January was revised upward by 117,000, a huge upward revision from a positive 49,000 to a positive 166,000. So those are the revisions for the prior 2 months of December and January. With these revisions, employment in December and January combined was 38,000 higher than previously reported. Then, of course, the fine print, yada, yada, yada. If we calculated it the right way or as we used to, the unemployment rate would be closer to 6.7%, so an increase of 0.5 percentage points. But That's in the fine print. We don't have to pay any attention to that. The Fed tells us it's closer to 10%. The initial jobless claims report tells us it's closer to 13%. So what to believe, who to believe, blah, 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 blah. I don't know why anybody in their right mind would waste their time trying to predict these numbers. You know, we got 379,000 for the month of February, beat all expectations. I mean, what happens, this is basically just for, I guess, economists to pat themselves on the back to see how accurate they are. What are you going to do? What else are you going to do with that number? I don't get it. Because you never know how the markets are going to respond to this crap. I mean, because it might be something, it might be one piece of data nestled in there, which is why you got to read the whole thing that, you think the headline, markets are going to go up, but then there's a piece in the report, markets go down. So what's the point with these forecasts? I really don't understand them because they're never right. So why waste your time? I don't. That's why I never give those forecasts for these numbers. It's all made up. It's all crap. But these are the numbers we live by. It's important to some degree, so that's why we go through it. Because we're trying to piece this puzzle together. And we get one picture from the initial jobless claims report. We get another picture from the jobs report. We get another from ADP and other private sector companies that give out certain data. So we're just trying to piece it all together. What makes sense? So 379,000 jobs created last month. 745,000 Americans filed initial jobless claims last week. You do the math. It ain't good. Okay? A lot of the jobs created last month were in hospitality, as we stated. A lot of those were in the restaurant and bar industry. The only problem being, of course, this is not sustainable. Why? Because so many small businesses, restaurants and bars have closed. For good. So they're not just going to open back up. All of a sudden, it's not going to happen. It's not going to happen. We have unit labor costs going up. And the entrepreneurs and the restaurateurs that are out there, they're going to gather and grab some of that market share, but guess what? They're going to be hesitant to start expanding, to start putting more tables in the restaurant, or to add on to their building, so they can have more seats and tables or another bar area, what have you. A lot of them might not even be in the financial situation to do it. Banks might not want to give them the money to do it, which we know is the case in many circumstances. So this quote-unquote boost here to job creation, of course it's not creation. These are jobs that simply were just gone and have come back. This is not some sort of net gain. This is just you're shut down due to restrictions. Come back once we can open up. And it also raises the question of how effective were those PPP loans, right? Because weren't really a lot of these people supposed to remain on the books if they could get the PPP loans? Oh, that's right, if they could get them. And most of them couldn't. That's why these people were laid off. Because these restaurateurs, these small businesses couldn't get the PPP loans. This is a debacle we find ourselves in. We are far from out of the woods on this. The idiots are going to pass another $1.9 trillion monstrosity. Here it comes. Yes, bickering here and there, filing amendments for this, that, and the other. It's coming. Then infrastructure, Green New Deal, healthcare, God knows what else. Okay? Buckle up. It's just getting started. The markets are busted. They are busted. They are broken. Anything can happen. Correlations, traditional correlations, are breaking down. They will continue to break down. We will see some very crazy stuff. Okay? Just be prepared. Do the best you can. And also, enjoy your weekend. That's February Jobs Report. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.